Alright, so we're going to discuss the fractal nature of swing formations surrounding the weekly and midnight opens. So, first thing is first, um, the formation of swings around higher time frame consolidations is obviously different than those of the in trending markets, right? So, the first thing is we want to identify, are we in a consolidating market or are we in a trending market? And sometimes while we're within a consolidating market, it can be a little bit hard to tell. But typically, we'll see consolidations around equilibriums of ranges after taking a significant high, such as previous year high, previous month high, etc., or after a continuous expansion, one sided expansion, right? Because we know that the market moves from ranges to expansions, from ranges to expansions, etc., and everything else in between is just a goal driven movement in order to achieve fair value to either accumulate or distribute orders to achieve either a long term goal um, or a long term price point. And so, first things first is that when we're in a consolidating market, we want to identify the external price points or areas near the external price points because, as opposed to a trending markets, I don't want to say they're a little bit more predictable, but trending markets will typically see a very positive reaction in a scenario where, for example, we're bullish. Typically, we'll see a positive reaction within the first half of the week when we reach a fair value point or a point of reaccumulation, which we'll see a swing formation and then later on an expansion. And so I wanted to share with you guys because your objective in this business is to essentially catch either the a close point of their reversal or a close finish line of the retracement in a trending market, or be a part of the expansion, right? And ideally, I mean, in both scenarios, whether you're catching the end of the retracement or the end of the reversal or the start of the reversal, you're going to be a part of the expansion, and that's kind of the entire goal of this, uh, of what we try to achieve on a day-to-day basis. And so there are a couple of, I don't want to say rules, but there are a couple of behavioral patterns, I guess, that the market provides us. And so swing formations on a higher time frame lead to, as I've said before, a lot of opportunity on the lower time frame, right? And so I wanted to discuss this week, um, and I wanted to kind of go through how we can utilize the midnight and the weekly open. So the idea is that in a consolidating market, you're going to be utilizing external to internal as opposed to internal to external because anything within a ranging market um, near equilibrium is likely to just be very, very choppy or close range, right? And so, what you're going to want to do is you're going to want to identify external price points surrounding the extremes of the current range. And then from there, you can identify swing points. And so, from a very simple perspective, what you want to do is ranging markets, identify externals, right? In expansion slash trending markets, you're going to want to identify internals. And while this may not be true wholeheartedly, you can still target some externals or, subjectively speaking. Um, Trending markets see internals to external more, right? And so in this ranging market, as we identify the externals, what we're going to do, and similarly for both of these, is that we also identify swing formations near these areas. And so whether, depending on whether you're a swing trader, whether you're a scalper, these time frame alignments are pretty subjective. But for the sake of this example, and we're using um, the weekly profiles, I'm going to be using the hourly candles. Okay, and so a couple of things to note. These two rules that I've outlined here are fractal in nature, right? And so if we know that in ranging markets we identify externals and we're likely to move from external to equilibrium of the range or near weekly open or kind of move towards imbalances, then what we're going to do is that we're going to apply that same rule on a lower time frame. And so for the sake of the example here, let's just say that this was our external level on the daily, right? Similarly, where was our external level within Friday? It was that same price point, right? And so ranging markets lead to expansionary markets, but ranges also provide opportunities in as far as when one side of the range is taken, we're likely to expand in the other. And so what you're doing here is essentially you're doubling down on the range effect. And what I mean by that is when you're trading consolidations, for example, and you're looking for longs, or your thesis is to look for longs, what you're going to want to do is position yourself below the weekly open. And so here I already have three factors going for me. I'm below the weekly open. There is an internal level, a significant imbalance here that was very illiquid, so price is likely to gravitate towards. And so as soon as I have a formation of an imbalance, right, and I'm looking for longs, so this is a sell side imbalance, buy side inefficiency. So we're likely to deliver buy side here. And so my eyes are going to go towards, I'm going to make this a little bit bigger. My eyes are initially, or they're going to go towards an external level where I can see a potential reversal from into an internal level. And while we're not in the business necessarily of catching the absolute bottom or the absolute top, that you know, it's debatable, but we are in the business of catching the expansion, right? And so what you're going to look for near these areas are going to be hourly swing formations. And you already have a buy set up, you have a thesis surrounding the idea of what you want to capture. We know that we're in a ranging market on a higher time frame. We know that we took a range low on a lower time frame. And if I were to zoom in a little bit more, we can see the factors that went into this. So I'm going to, for demonstration purposes, I'm going to head down to a really low time frame. But in this case, what you would do is that a lower time frame or a higher time frame swing formation on a lower time frame is a CSD. It's an order block and a CSD. And so we want to ask ourselves, what was the candle that took liquidity, right? And so it was this one here. And for the sake of the example, I want to go a little bit, yeah, there we go. And so what was the candle that took liquidity? And so in this case, this was a singular down close candle on the 5 second. And the job of this candle was to essentially come down, breach liquidity at a high impact news time at 8:30 o'clock, which is NFP. And a close above this candle signifies a change in the state of delivery. Why? Because we've done multiple things here. We've swept liquidity of a range low, of previous daily low, and we've also reached an external level on the daily. And so these are the factors that you want to plot together. So you want to have a range, right? And you also want to have, so we have a range market here, and then we have our external level here. And so we have our range low. There we go. So we have our range low. We have our external level that we're likely to see a mean reversion from. And then we also have a range high. Whoops, it's a little ugly, but you get the idea. A range high that we're likely to target towards. And so in this area here, what you're going to be looking for is a CSD on a lower time frame. And once you get that closure above the down close candle or candles that led to that sweep of liquidity, that confirms our CSD. And then from there, we're utilizing multiple concepts at once, right? So the expectation is that we're going to go higher, right? And so how can we dig a little bit deeper into these ideas, right? And so we have a lower time frame CSD. We have, I'll mark this out for example. We have we have our 8 o'clock open, and then we have our 9 o'clock open. And so during a swing formation, the candle that took liquidity, this one here, the candle that comes after is likely to retrace within. So we're likely to retrace within this area here. Let me outline it. So this is the range of the 8 o'clock candle, right? This one here. And so during the formation of a swing, what's going to happen is that the open of the next candle, if we're bullish, the same way we treat the weekly open and the daily open, the opening of this candle from the open to the low, because we're bullish. So when bullish, we look for open to low. When bearish, we look for open to high. Why? Because bullish candles equal open, low, high, and close, and bearish candles equal open, high, low, and close. Right? And so the expectation is that the close of this candle, of this 9 o'clock candle, is going to be higher than where it opened at. And so our job is to identify an area where between this long-term low that we're expecting the 8 o'clock candle to be placed in, where we have to look for a range within this 8 o'clock candle low, and this can be applicable on all time frames. The next candle, we have to identify an area of fair value within this 8 o'clock candle low, below the opening price of the new candle, that'll allow us to make the short-term or the intermediate term swing on the next side that can lead to the expansion. And so if that makes sense, which hopefully it does, you will get the formation of either an order block here, breaker, etc., FEG, which you can later then utilize for higher prices. And so again, just to reiterate, when bullish, we look from open to low. When bearish, we look from open to high, and we look for PD arrays within this area, or an area where a lower time frame swing can be formed. And then bullish candles are open, low, high, and close, and bearish candles are open, high, low, and close. And so again, this is applicable on all time frames, right? And so as you can see here, we had this 8 o'clock candle, we had the 9 o'clock candle open, right? Trade into fair value within the range of this 8 o'clock candle, which is also within fair value of the daily candle. And so now we're stacking probabilities on our side here, right? And so what I want you guys to really focus on is just a really simple three candle formation near the weekly or the daily open, right? And so just to give another example, it can be this one here. And it doesn't necessarily have to be the hourly, but this one here. And so in the scenarios where I'm bearish, I'm going to be looking for what? Open high, right? And so anywhere between this open here, this opening price here, and any PD array or any buy side liquidity that I have available to me, I'm going to be looking for that three candle formation. And so in this scenario here, we had these equal highs here. And so under a bearish scenario, I'm going to be looking for a couple of things. I'm going to be looking for imbalances that were created on the way up that produced higher prices. In this example, it was this buy side imbalance here. And then I'm going to look for a swing formation above these highs. A swing formation above these highs. And so what confirms my CSD in this case is the candle, the up close candle that led into the high of the sell side of the buy side liquidity. So the candle that led into the liquidity pool. It closed below that confirms my CSD. And so this is applicable on, again, all time frames. But what you want to be doing is that you want to be looking for swings within the context of your higher time frame narrative and within the context of the weekly, the daily, and the hourly candle open. Or in many scenarios, I know a lot of us or a lot of traders like to use the 4 hour candle open. And so similarly, you're going to be looking for that same reaction. So in this case, we have swing point that took the liquidity. So the next candle, I'm expecting an open low where it's going to utilize the range of the first or the second swing candle, or the first candle that took liquidity, and it's going to utilize this range to seek fair value below the open of the new 4 hour candle, which you would pair this low with a PD array, and then you would seek higher prices from there on and so forth. And that same way we're seeking this fair value, and that same way we're seeking for this swing formation on this higher time frame, I can simply go down to a lower time frame, right? I can mark out the open of the of the 10 o'clock candle, and as soon as we reach fair value, so in this case it was this order block here, for example, or mitigation block. So we had the open, price came down, it tapped into the order block and saw a swing point formation. And so now from this point on, I can either look at the candle that swept or the candle that closed below the low of the 4 hour candle open at 10 o'clock, or the candle that swept into liquidity or swept into the PD array, and I look for a close above that. And a close above that will confirm my CSD. And so now you're applying the fractal nature of all of the concepts that we've learned. We're looking for swing formations within a bullish narrative that has been created on a higher time frame, because we're expecting the 4 hour to move up, and we're expecting us to reach an internal liquidity level after reaching external. And so again, you're going to be pairing external to internal, internal to external, right? And at these price points, you look for swing formations and lower time frame swing formations and CSDs in the direction of either external or internal, depending on the context. And I wanted to kind of go over the simplicity of this and the way you can utilize time, because the reality of it is candles, can only do certain amount of things. And so you're only looking to engage in price whenever your predefined external or internal level is hit, and then you look for that swing formation, right? And this can be, again, in the context, and ideally you want to be below the weekly open or below the daily open if you're looking for buys, and above the weekly open or above the daily open if you're looking for sells. And so now one more aspect that we can add of time that's fairly simple and is applicable to every single day are the daily profiles, right? And so the daily profiles are there to help us define what the next session is likely to do. And so we have that if this then that factor. And again, to reiterate, consolidating markets and expansionary markets behave very differently, in the form that we're likely to see more reactions from internal levels on expansionary weekly candles within the first half of the week, whereas consolidating markets are likely to seek external levels and then move towards internal. But irregardless, you're still likely to catch a significant or a really well-defined daily profile. But for the sake of another example, I'm going to move to an expansionary example. So in this case here, please excuse me. So in this case here, actually, let me seek a better example. So in this case here, we have our Monday, we have our Tuesday, we have, I guess this isn't the best example. We have our Wednesday. We have, not bad, Thursday, and then Friday, right? And then just to close it off, just to close off the week and have it defined, that's the close of the week. So we have the close of the week, right? We have the open of the week. We're currently under daily expansions and 4-hour expansions, right? And so the idea is that we would like to see the low of the week be created within the first half of the week. And so typically this will be Tuesday or Wednesday, right? And so because we know that, or we're trying to frame this sell side expansion, lower time frame sell side expansion, as a daily or a 4-hour retracement, we're likely to wait or just wait until an area for value is hit on a specific day where we would likely see a CSD. And so in this case, I'll just mark out this one for the example. We'll say, whoops. We'll say that this reference point is what led to the expansion and the CSD. Right. So continuing here, that same way that you apply, if Tuesday is the first candle of the swing. Tuesday is the first candle. Wednesday is the second one that sweeps the liquidity and reaches into the higher time frame point of interest. Then Thursday and Friday are likely to expand. And that same way you're defining that is the same way you're going to define sessions. So in this example here, we had Asia and London create a range. So what's New York likely to do? New York is likely to expand, right? Only in the scenario if fair value has already been reached, or it can AMD. And so because we had the creation of a range here from both of these sessions, we AMD'd into an area of fair value and then saw a continuation expansion. And so similarly here, again, we had the creation of a range. We did not reach fair value. Price AMD'd during a manipulation time at around 9 to 10, and then saw a bit of an expansion which led to a continuation. And so if you'll excuse me, this example here, we had the open, we had a retracement, right, into this volume imbalance around London open. And then we saw a close above an imbalance that was created here. And so again, what you're looking for is if London creates a high or reaches a point of fair value after a higher time frame point of interest has been hit, and we get a significant move in the direction of what we're expecting to be the weekly candle expansion, then that is likely to be the low of the day, right? And so in this example, it came really close, but London set the low of the day, then New York is likely to retrace and continue expanding. And so what you're doing is that you're setting up and defining what each day has done and what each session has done in order to provide context for the upcoming session or the upcoming day. With the idea of having swing points in mind and lower time frame CSDs to confirm these swing points. All right. Thank you very much, and hopefully you guys enjoy this simple video.